Yeah, we're a half hour from the open in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Stephen Engel with Annabelle Jewelers.
Our top stories: Asian stocks slipping as the yen gains following hotter than expected Tokyo inflation. Aussie bond yields in focus as the RBA governor says price pressures there remain too high.
Well, the Chinese consumer sector also in the spotlight today, with Meituan's quarterly earnings growth expected to accelerate in a sign of gradual recovery.
And Link Asset Management CEO George Hongchoy joining us exclusively this hour for their outlook on the retail sector in Hong Kong and the mainland. Taking a look at how trading is faring this morning, and really as we close off the week here, last day of trading for November as well, we're seeing Asian equities a little bit under pressure but fairly flat so far, and you can kind of expect that given we had the Thanksgiving holiday overnight. We don't have that lead in coming across from the US session. S&P 500 futures again very flat right now. Where we are seeing sort of more of the trading activity so far in the session is really coming through in the FX and also the bond space as well. Let's take a look at for instance how the Japanese yen is faring today, because we are actually just seeing it moving against the greenback here. Quite a big move, actually. A bit of strengthening coming through. So what's happened is we actually had the Tokyo inflation figures. That's a leading indicator for how CPI is faring in Japan, and we saw it speeding up above that 2% mark. That is the BOJ target, and so it very much makes that December meeting a live decision. Aussie bonds telling us a bit of a different story, actually, this morning. We're seeing yields moving a bit high here today. We actually heard from the RBA governor saying that essentially inflation is still too high. ANZ, for instance, out with a note earlier, the bank in Australia, saying that easing is going to start in May of next year. They'd previously seen it in February, and now they're actually expecting 2 cuts of 25 basis points. Again, they had seen 3 earlier. So it's an easier or a shallower easing cycle to come there, perhaps. Brazilian real, of course, in focus. We are seeing it trading at a record low against the greenback. We had the Brazilian government coming through with some spending plans or spending cut plans. Those have very much disappointed investors, and we are seeing those second-order effects. So, for instance, some of the assets that are listed in Asia today coming under pressure. One of those is Brazilian critical minerals or materials listed in Sydney. That stock is down as nearly 10%. And also, of course, looking ahead to what happens with Chinese equities today, given we've got the Hang Seng Index on track for its worst month since January of this year. So it really tells us maybe that expectation around stimulus has sort of dissipated right now.
Yes, but at the same time, there was the reports yesterday that perhaps the Central Economic Work Conference, which is going to be held in Beijing next month, which is coming up in a few days, could be earlier than expected, and a lot of speculation midweek that there could be some more actual physical stimulus that could help the consumers. Yeah,
well, you certainly get sort of those projections and those spending plans coming through at that point as well. So, again, hopefully it's something to sort of reignite that interest in Chinese equities. We actually do have stocks on track for a weekly gain today, and it is still that story around earnings that's coming through. We've actually got Sang-Mi here to talk about what's happening with Meituan, but that stock is going to be very closely tracked. It's actually the heaviest weighting on the Hang Seng Index as well. And listing coming up as well, we've got Morning Grand Jewellery listing at the bottom of this hour. Again, just another test for the IPO market in Hong Kong. Yuan Fix, given we've seen that long string now of stronger than expected readings coming through from the PBOC, and Hong Kong retail sales data, very interesting given we've got that big interview coming up later this hour.
Absolutely. We'll be watching all these. Meituan is a very interesting story as well, because you think the consumer is not doing well in China, but actually they have been shopping quite well. The stock has more than doubled this year. It's up 55% in the third quarter. Sang-Mi, as you said, we'll be talking about that. We're at the tail end, though, of China's earnings season. In fact, we mentioned Meituan. It's the last of the major Chinese tech companies to be reporting. About 95% of the companies in the MSCI China Index have reported. More than 60% have surprised to the downside, while a third have beat expectations. Just 4% were in line with analyst forecasts. Go ahead.
Well, for more, obviously we both want to talk about this, but bring in our Asia stocks reporter, Sang-Mi Cha. So, Sang-Mi, what's front and center today? I mean, I think would have to be Meituan, right?
Right, that's true. It's going to be reported after the market close, so we're watching closely. Analysts are saying that it's going to be good because, just like Steve mentioned, the spending has come, turned around a little bit in the space of travel and delivery and e-commerce. That's what all the Meituan businesses are. So it's going to look better. They're expecting that. And we're also watching some other stocks, obviously. New World, after it was deleted from the Hang Seng Index, it's also selling the science park in Kai Tak to Chow Tai Fook. So that will be a stock that we're closely watching. And of course, we're following, how the real implications of the tariff that the president-elect Donald Trump mentioned. Is it really going to be 10% on top of the 60% that's already been threatened, or is it going to be just 10% of its own? So a lot of the exporters, we're watching those very closely.
Yeah, but Meituan perhaps could be that bellwether for the retail space in China, as well as kind of giving a little bit of a lift to the tech sector, because it's been fairly lackluster reporting season for tech, hasn't it?
Yeah, that's right. And we actually have been looking at the volatility space in options. And when we look at the cost of protecting against the swings in Hong Kong shares, it's slumped to the monthly low in about 4 years, more than 4 years, actually. And so HSI volatility index is now fallen 9.3 points in November, and that's actually the lowest in about 2 months. And remember, on September 23rd, right before the stimulus blitz was actually unleashed, we saw the same gauge go up more than the 2-year high. And the reason was because all the investors were piling in to, get that outsized gain from these equities rise. But it's really interesting to see that in the Asia market, it works a little differently from the VIX index, for instance, in the U.S., which fluctuates in the opposite direction from the S&P 500 80% of the time. But in Hang Seng Index and Hang Seng Volatility Index, we see that they actually move in tandem, that they did so 53% of the days this year. And that's because a lot of the traders in Asia want to use options for further gains rather than focusing on the hedging like the U.S. peers do. So that's an interesting thing. And so we'll be watching how all of these pan out. Of course, the slow-paced rollout of the Beijing stimulus and the tariffs that I mentioned, and not going that far to Trump administration, but Biden's administration is now eyeing to impose more sanctions on Beijing when it comes to access to semiconductors. So all of these the traders are watching very carefully.
It'll be an interesting final month to the year, definitely. Sang-Mi Cha, Bloomberg Asia stocks reporter, joining us there. And later this hour, we'll look deeper at the Chinese consumer coming up. And WPIC Marketing and Technologies tells us where they're seeing growth opportunities in a saturated market.
Let's get more on the markets now. Bring in Ben Bennett. He's Asia Head of Investment Strategy at L&G Asset Management. And it's sort of a funny end to the year, I think, because there's really a lot of unknowns, it seems, still. We're, as Steve was saying, we're sort of waiting for any further details we get around China's stimulus, perhaps in the next even few days. And we're waiting to see sort of the impact of tariffs and exactly how that's going to look. And we also don't know the inflationary impact as well. So how are you sort of thinking about investing right now?
Yeah, it's difficult. I think we've sort of reduced some of our positions recently for some of the reasons that you've just said. So we were overweight emerging market equities throughout the summer, thinking that the Fed, of course, was cutting interest rates, so that was going to be positive for emerging markets because the dollar's going to be a bit weaker. Then we had the Chinese stimulus announcement, and everything went very well in that trade. We've taken that off now because I think the uncertainty is there.
So where do you shift into, though?
Yeah, so we were underweight Europe and Japan on the back of that overweight emerging markets. So we just cancelled the whole thing, to be honest. So we just neutralised because we're just waiting for some more information. If they come out with some more stimulus in the meeting in December, then perhaps we'll be wanting to add a bit more. Personally, I think we'll be wanting to sell on strength because I don't think it's enough what they're doing, and I don't even think that they want to do the stimulus. They don't want to reignite the property market. They don't want the stock market to soar up. So for me, I'm going to be selling on strength, to be fair.
What signals then, or what would be really enough then to give you greater conviction in investing in China? Because these are sort of multi-year structural problems the economy is facing.
Absolutely. I don't think that they want to reignite the infrastructure spending. I think they want to shift, of course, into these new technologies. And ultimately, the answer is to reignite the consumer. And it's interesting what you're saying about Meta and how consumer stocks in China are doing a bit better. If we're going to be buying anything, it is going to be around that consumer story and maybe less on the infrastructure. And that does benefit the onshore equity markets in China rather than the offshore. So that's the thing that we're looking out for.
Where do you look at fixed income and credit as a whole? You do like Chinese consumer credit. They've been issuing a lot of convertible bonds of late. Yeah. But what's your overall position as you kind of pull back from some equities region-wide?
Yeah, actually, the overall credit position that we have is underweight. Credit spreads globally, I mean everywhere, and including in domestic China, credit spreads are so tight. We're basically at the 20-year tights for credit. I still think credit, let's say dollar global credit, will return, say, 10% this year if we get this perfect Trump-inspired soft landing. But there are risks to that. And it's going to be mostly driven by government bond yields actually falling, I think. That's the way that we're positioned.
JGBs, of course, a big focus today. We just had those Tokyo inflation readings coming out. But I noticed that you've got, as a contrarian position, you're liking JGBs as you think inflation could actually end up undershooting.
Well, actually, the reason why we've got a contrarian position is because we just think it's really hard to forecast interest rates, to forecast inflation. Take the IMF. They've got 1,000 economists. They spend $100 million on forecasting macroeconomics every year. Over the last 30 years, they forecast correctly 8% of recessions the year before. It's really, really, really hard. So when we see a lot of confidence in a trade, and I think a lot of people think that the Japanese bonds yields are going to go up. They think that the Bank of Japan is going to be hiking interest rates. When that's really convicted, we actually like to oppose that. So it's not a strong opinion, it's just against another strong opinion is the best way of putting it, I think.
Where do you see the currency risks in this area with the King dollar still having some momentum?
Yeah, so I think that could fade a little bit, and partly because President-elect won't want to see the dollar strengthen, because otherwise that undermines the whole point about tariffs, doesn't it? If you can depreciate your currency by 10%, you've offset the 10% tariffs potentially. So I think that the dollar, having appreciated now, will probably stabilize a little bit, although we are seeing some pockets of volatility. I mean, you talk about Brazil just now. I think that's the problem. It's going to exacerbate those pockets of volatility, but ultimately I think it's going to be a sort of steady dollar.
What about in European markets as well?
Yeah, overall, Europe credit, we like European credit compared to dollar credit on a valuation perspective. We also, again, opposing the general trend which says that Germany is going to be very weak next year. That's what consensus says. Again, I think that's really hard to forecast. There's going to be a new election at the beginning of the year, and maybe they'll change the fiscal rules. And at that point, I think Germany could positively surprise. It's a very low bar, I think, is another way of putting it. So maybe German bond yields could start to go up a little bit.
You mentioned the Brazil story. I want to come back to that. It's one of our top, most read stories on the Bloomberg terminal right now. How significant is this? And is it just a Latin America story, or is it a broader story potentially?
No, I think it is significant. And I think that with a strong dollar, a lot of countries have got to be careful about their fiscal balance, about their spending plans, because they're going to get punished more. The whole of emerging markets prefers a weaker dollar. I mean, that's just perfect. And that's why we were overweight emerging markets in the summer, and that's why we've taken it off now, because I think this sort of thing is going to flare up a little bit more.
What about the fiscal spending plans in the US? How are you thinking about that? And do you think that Donald Trump back in the White House is going to end up being constrained in any way on that front?
So the fiscal deficit, so right now the overspend is huge. It's sort of 7.5% of GDP. Next year we reckon it's going to be about the same. So it's going to be huge again because Donald Trump presumably will just extend his tax cuts, but it probably won't get even bigger. So from a sort of fiscal standpoint, the debt is going up by too much, but it's not. I don't think it's accelerating. So I'm not particularly concerned about this. I would add a little bit of bond yields, a little bit of yield to the current 10-year bond, and maybe the dollar could suffer a little bit on the back of this, but I'm not too concerned about it. And he might, as you say, be constrained by the bond market.
We've jumped all around the planet this morning. I want to come back to Japan because Annabelle mentioned Japan earlier and JGBs. We're seeing continued yen strength, even though that's a relative word because at 150 to the dollar, it's still on a historical perspective quite weak. But again, it's up about 1%. We saw Tokyo CPI at 2.6%. 6%. So inflation momentum is picking up. Does that translate to, tighter rates from the BOJ at a time when the governor is actually pausing a bit?
Yeah, I mean, in Japan, they've got the political uncertainty as well. So I think that's been... And we had the situation back in the summer when they hiked interest rates and the bottom fell out of the stock market. So I think there's a lot of caution around what they might want to do. Yes, of course, these data today suggests that you want to be tightening interest rates. We're going to get the overall Japanese inflation in a few weeks' time to see if it's the same thing. Yeah, that's the risk. But like I said, from my perspective, I just need 2 or 3 inflation prints that are not higher than expected, or actually lower than expected. And then I think that's when investors will think that perhaps we're not going to see higher yields, and that's how we're positioned.
You mentioned sort of that market dislocation around the yen trade or yen carry trade unwind that we had early this year. Do you think that risk is again fully appreciated or baked in?
I think it could happen again. It could flare up. We haven't spoken about France, have we? That's another interesting topic. And we know as well that lots of Asian investors have bought France bonds because it's a little bit like Germany with a little bit extra yield, but there's no such thing as a free lunch, is there? And we're starting to see that yield as high as it was back in 2012. I mean, that's the 10-year, 12-year high. So I think that could be another trigger to keep an eye on. We'll be watching that before the end of the year. So maybe it's not going to be quite such a boring end of the year at all.
I actually think it's anything but. It seems like a big waiting game at the moment with a lot of loose ends still to be tied up. But that was Ben Bennett there. He is the Asia head of investment strategy at L&G Asset Management. And also just quick note to note, we have the yuan reference rate coming through again, another stronger fix from the PBOC here, so coming in at 7.1877, quite a bit stronger than what the estimate had been seen, and really just get that big question mark around how much power does the PBOC have to push back against that tariff risk. Yeah,
I never expect a boring day. Yesterday we thought it was going to be a slow day heading into the Thanksgiving holiday in the U.S. BOK, cut rates, all kinds of stories just flooded us right here during the China show.
All right, we're going to be counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. Futures, of course, looking ahead to a bit of a weaker start here. This is the China Show.
And welcome back to the China Show. Well, China has abruptly suspended a senior official from the nation's top military body led by President Xi Jinping. It's the latest escalation of a corruption investigation that's rattled the leadership of the People's Liberation Army, or the PLA. Let's bring in our China correspondent, Min Lo, here in Hong Kong. Min, what do we know? Because this story has shifted emphasis. We thought it was the defense minister who was under investigation. Now it's somebody else. What do we know?
Yeah, well, with the PLA, it's always been a very opaque body, so we never really know what's really going on. But officially from the Defense Ministry, we know that Miao Hua is being suspended. He is part of the 6-man Central Military Commission, which is the apex decision-making body of the PLA, and it is headed by President Xi himself. There are 2 vice chairs under presidency, and Miao Hua is the 5th ranking officer who is in charge of overseeing political loyalty in the army. So you can imagine that his position needs to be held by someone who is redder than red, but he's being charged being investigated for a serious violation of party discipline, which is usually code word for either corruption or some sort of party disloyalty. And as you said, this comes about a day after the Financial Times reported that the Defense Minister Dong Jun could be investigated as well for corruption, potential corruption that's according to U.S. officials, but Beijing has denied that. The Foreign Ministry is saying that the reporting is 捕风抓影, that translates to catching the wind and catching the shadows. So
pure fabrication, I think, a loose translation as well.
Yeah.
China's military has more than 2 million active soldiers or troops, and it is the world's largest military, but we've reported for quite a while now about the serious weakness within it. So what are the implications of this story for President Xi and also for the broader PLA?
Yeah, obviously it shows how widespread the corruption allegation is, because already we have the 2 former defense ministers, Li Shangfu and his predecessor Wei Fenghe, who were basically denounced from the party for corruption. And then there had been more than a dozen senior military officials that were also unseated ever since China embarked on this corruption purge, looking into hardware purchases going as far back as 2017. And this also raises question as to the selection selection process for these officials, because President Xi is seen as someone who had personally promoted someone like Miao Hua. So has he placed, misplaced trust into some of these subordinates? Obviously, questions around combat readiness as well, because this is a time when China is projecting power into the South China Sea, the Taiwan Strait, two of the biggest flashpoints in U.S.-China relations. And some analysts say that the extent of this purge could even be beyond President Xi's anticipation as well, showing how widespread it is, going to the very upper echelons, the elites of the PLA as well.
All right, something to be watching very closely. That was Bloomberg's China correspondent Min Min Lo there. And just a quick check on futures, because we are about 7 minutes now from the open of trading in mainland China, Hong Kong. Also tracking the IPO space this morning, because we've got another listing coming through. This is Mock & Grand Jewelry. It's an original gold manufacturer based in China. That stock is looking like we're going to see a little bit of upside at the open, but overall it's looking to be perhaps another day in the red for Hong Kong at least. But we'll have plenty more ahead. This is Bloomberg.
And welcome back to the China Show. We are watching and tracking the Japanese yen against the U.S. dollar. As you're seeing some strength come into that currency. Will it breach 150 down to 149 and change? Right now it's hovering right about that. We did get some more data on sticky inflation. Tokyo CPI coming in at 2.6%. Whether that's enough, obviously, to change the minds of the governors at the BOJ, yet to be determined, obviously. But 150 and change could be breaching 149.
Yeah, well, I mean, I think it very much makes that BOJ decision in December a live meeting and one to be watching.
Aren't they all live now?
Probably, especially after the BOK surprise yesterday. But here's a look at Hong Kong ahead of the session here today. We're seeing a little bit of downside pressure. That's the expectation. Watch on the offshore yuan there. We just had a stronger than an expected fix, the 18th straight one in a row. Also taking a quick look at analyst actions. We've seen JP Morgan with some analyst, or rather airline upgrades. We've actually seen China Airlines International recovery nearly complete. That's according to our Bloomberg intelligence team. Some of the stocks that we're tracking as well this morning. Mock & Grand Jewelry is one we've got that listing just ahead, and we are seeing some upside. They raised $530 million from their Hong Kong IPO, and also Meituan, one to track as well. Earnings in focus, Steve.
Yeah, that's right. Meituan, obviously the bellwether of tech, because it's the most weighted stock in the Hang Seng Index. We'll be watching this later. And welcome back. You're watching, of course, the China Show. We're counting down to the open of the markets at this bottom of the hour. Of course, Hong Kong and China set to open. Can China still keep some momentum, or is Hong Kong also going to keep on path for that losing month again?
Well, certainly we're setting up for the weakest month we've seen for Chinese equities going back to January of this year. So it certainly tells you that all of that optimism we had around the stimulus announcement from September has pretty much faded in markets. Of course, you were saying that maybe we'll get some more details from policymakers just in the next few days in terms of sort of spending plans. Anything further we get on the fiscal front, that's going to be very closely tracked. But as we count down to the session of today, of course, remember that we had US markets shut overnight for the Thanksgiving holiday. Right. So there's sort of lower trading volumes across the Asian landscape this morning. The CSI 300, though, has just come online. Again, fairly flat today. We aren't really seeing too much movement. Keeping a very close track, though, on what we see in terms of the offshore yuan and onshore in particular. Given we just had that stronger than expected fix coming through, we are still seeing, of course, what's happening in the metal space, and we've actually got iron ore moving here a little bit to the upside. But again, it's looking pretty lackluster to end the week. Let's take a look at what's happening in Hong Kong today, because it's still that focus. We're just wrapping up earnings season. It's pretty much disappointed investors as well across the board. But we do see the Hang Seng just fractionally high here. Hang Seng Tech, another one to watch closely. Meituan, you are actually seeing that stock moving fractionally in the green this morning, but earnings is going to be the really key one to track. We're actually expecting, or analysts on average are seeing the company growing net income by 164%. So really, if there's a company that sort of stood out in its ability to to retain and expand its consumer base against very fierce competition in the delivery sector generally in China. Meituan is doing a good job. EVs, of course, let's take a look at how they're faring so far in the session. We actually heard from the Mexican president overnight talking about BYD's proposed plans or possibly building a plant in the country there. She actually said that they haven't received a firm proposal just yet. So some question marks over that. We're seeing BYD, again, little change so far. Another IPO we are also noting today because it's actually the second major one we've seen this week. But Mokangran has raised $530 million in this listing, and we are seeing some good upside today. Those shares were priced, I think, around $12 a piece, Steve.
Yeah, I think the markets, as we are trading in the final day of November, still waiting for potential stimulus coming out of Beijing, perhaps at the Central Economic Work Conference that will be held in December. And there was, with Meituan, a little micro stimulus because the local governments gave out consumer vouchers that really helped boost some of the numbers at Meituan in the food delivery space. Well, Hong Kong-based real estate investor Link REIT has released its 2025 interim report, warning that market conditions will remain challenging amid continuing macroeconomic transitions. Joining us exclusively now here in our Hong Kong studio is George Hongchoy, Executive Director and Group CEO of Link REIT's parent, Link Asset Management. Good to see you again.
Good morning. Good to see you again.
So a good headline crossed the Bloomberg terminal within the last half hour, something you touched on in our last interview here in the studio in May, I believe it was, and that is the multiple entry visas for mainlanders to come across the border and hopefully shop. It's happened now. They're going to be approving that. How important is that for Hong Kong retail sales, which have been down 8% in the first 9 months of this year?
It has been one of the things that have dampened Hong Kong's retail sales. A lot of our Hong Kong shoppers have gone across the border to shop, and almost an imbalance of not having that many to come back towards our way. And so we are looking forward to welcoming more people to come more often. This is something that we had many years ago and was suspended, and so we're very pleased with the announcement. The mix of the visitors has also changed over the years. More second, third-tier cities to bring back frequent visitor from Shenzhen and Greater Bay, certainly, including Hong Kong as a regular visit location within their 1 hour or 2 hour living zone is very important for Hong Kong.
How would you sort of think about the consumer? Is there a difference between a Hong Kong shopper versus one coming from Shenzhen? I mean, we've often sort of thought about maybe that you can have a lower spending per person, but actually I attended an event at Shao Hongshu the other day, and they were saying that people are spending quite a lot. So what's your sort of projections?
The mix of shoppers have really changed over the years. A lot have come to Hong Kong still for some of the best shopping and restaurants. Hong Kong shoppers have gone up to China, to Shenzhen for services, for food, etc. And I think having that option for them is important, to be able to come as often as they like. Obviously, what we need to do as a landlord and our tenants is making sure that we give our shoppers the right offering, local and visitors.
Well, how do you see these dynamics, obviously, with people going across the border to Shenzhen and shop at Costco or wherever, but also now, if you have more mainlanders are coming down here? Keep in mind, Hong Kong's expensive because of the dollar has been so strong for so long. So how is this overall into 2025 going to impact your retail leasing performance?
Hong Kong is facing a structural change, given that obviously shoppers are going to shop in China, to spend in China. But this is part of the development of us becoming part of Greater Bay, that Hong Kong people can have that choice of living, shopping within the entire region and vice versa. And so it is a change that we all need to adapt to. At the end of the day, for retailers, for restaurant operator, is how to have a great experience for anyone who come, and so have to constantly renew their offering. It is a good challenge. It's competition, I guess, will hopefully bring the best out of Hong Kong, as we always do. And Hong Kong always will bounce back. And this is a great catalyst for us to be waiting for and now finally announced.
But you're saying that it's a structural change, and it seems like, I mean, if we're talking not just beyond Shenzhen, exactly, the Greater Bay Area has a lot of different options for consumers. So thinking about Hong Kong bouncing back, what's your timeline around that, and how does that actually play out?
Well, it will take a little while, partly because we also, part of the structural change is also the increase in supply of retail space in Hong Kong. And there's continuous supply over the next few years of new offering. Yeah. But that also could be bringing some excitement. Some of the design of the new mall is very attractive. There's a lot more things to do in terms of placemaking and activities rather than just coming out with a shopping bag. A lot of the experience that people didn't have when they come to Hong Kong. The mega events that the government has been promoting, including concerts and exhibitions and conferences, will continue to draw people to Hong Kong. And I think it will take time to absorb this supply and demand imbalance for a little while.
I think that supply issue is a big one, not just in retail. There have been some shuttered shops. It's expensive, obviously, to lease out property, whether it's here in Central or elsewhere, but also these office towers. Across here, there's the new Henderson, there's the new Chung Kong Center 2. There's a lot of commercial space, floor space coming on, and vacancies. So is that a 1 to 2 year time frame, 5 years to soak that up?
The absorption rate have not been as high as a couple years ago. We certainly want to see more new tenants coming to Hong Kong, not just for existing tenants to expand. New tenants that has been expected, whether it's from China or regional head office, family office. And so all these promotions about attracting them to come to Hong Kong to have an office here is significant. That plus supply of residential, with the residential price coming down. So the adjustment in several ways, supply-demand imbalance that we're talking about, the negative wealth effect affecting both companies and shoppers are affecting, obviously, sales as well.
But not too far from us right here is Pacific Place, which for people that aren't familiar is office and retail space. And Swire Properties earlier this year lowered their rents in that precinct by 16%. How much do you need to cut your rents to try and get that occupancy rate?
We are in a slightly different position. We have community mall, neighborhood shopping centers for daily necessity. So it has always been a little bit more resilient through market cycles. We do see negative reversion coming, but probably not at the same level relative to some of our peers.
What's your outlook? You talked about Greater Bay. What's your outlook for your retail portfolio on the mainland in the top tier cities, whether it's Shenzhen or Guangzhou, but also, of course, Beijing and Shanghai? And is there enough stimulus to kind of put a floor on what's been a pretty rough time for the property market, the multiple different elements to the property market in China?
We see a slowdown in spending for the last few months, partly because there is that question about the amount of stimulus, when it will come, whether it will actually trickle down to consumers. And so everyone sort of take a pause. And so we see some of the purchases, especially in discretionary items, have indeed dropped, whereas F&B and all that continue to be quite strong. So I think this confidence, consumer confidence really drives their spending behavior. And we're all waiting for news, both from a business angle and also from the consumer, hopefully getting them excited and go back out and spend, especially on the discretionary items.
As you think about where you want to be investing as well, if you were to take a look at the spread of office yields in Hong Kong over US 10-year Treasury, it's negative in Hong Kong. It's positive in Singapore, Sydney, Melbourne, Tokyo. So how are you thinking about where you actually want to invest and also investor interest?
We have actually been investing and divesting outside of Hong Kong for some time. We started that process in 2015. Indeed, the process of our diversification and the result have shown that this has delivered a very resilient set of results for our investors. Without that diversification that we started a few years ago, I think we will be more challenged. The diversification, looking for these better, more resilient growth income in other markets will continue, and that's part of the focus of what we're doing, what we articulated as part of our Link 3.0 strategy, active portfolio management, changing it, improving the productivity and the diversification, and then adding on to it the fund management business that we are trying to launch.
George, I've been covering the Hong Kong Stock Exchange a lot with Bonnie Chan over there. She's been talking about the 10-year anniversary of the Stock Connect. What is that going to do for you when you're included, Link REIT, into the Stock Connect and the demand either southbound or northbound?
Well, the regulators and the stock exchange, CSRC, have announced a policy of adding REITs to a REIT Connect. The detailed regulations and rules are still being worked on. And again, like when we were talking about the multi-entry visa, we hope that will come soon. And REIT Connect, again, we're waiting for that date when all the rules comes out. And I would expect that Link REIT will be included in REIT Connect.
By when? What are you hearing?
That's for all of us to guess.
All right. George, thanks so much. George Hongchoy, Executive Director and Group CEO of Link Asset Management. Thanks for joining us.
And you can get an insider's guide to the money and people that are shaking up the finance hub in our Hong Kong edition newsletter. That's out every Thursday. You can sign up via Bloomberg.com/newsletters. We'll have plenty more ahead. This is Bloomberg. Taking a quick look at currencies this morning, keeping a particular watch on what's happening with the Thai baht because we've actually seen it set for a 2-week high. Stocks actually have been weakening in the country. Japanese yen, of course, another one to track. We are actually just seeing sort of some dollar weakness coming through against the offshore yuan as well. But the Japanese yen, after we had that Tokyo inflation reading accelerating this month as the government reduced energy subsidies. That is in line with the BOJ's projection. But let's get more on that now with our senior editor, Brian Fowler, who's joining us from Tokyo this morning. And Brian, this inflation reading that's come out, of course, we know Tokyo inflation to be that leading indicator. But what does it sort of tell us about CPI more generally in the country?
Yeah, well, the data came in a little bit hotter than expected, and of course, it's the CPI gauge is above the BOJ's target. Ahead of these data, about 50% of surveyed economists were looking for a hike in December. Another 30% said January. Looking at the market, the overnight swaps market said about 60% bets were on a hike in December. That edged up a little bit in the wake of these figures. And I think it's important to know this is the last CPI report we're going to get ahead of the December 19th decision. The nationwide November CPI comes out one day after that. We also have the Tongkang coming up ahead of that. But Governor Ueda has said that he's going to be sifting through a lot of information, a lot of data. The December decision is going to be very much live. And I think today's figures probably back the case for a move in December more than January.
And Brian, as we're seeing on the screen along with you, the yen has breached 150 down to 149 and change as it is strengthening, perhaps on the back, obviously, of this Tokyo CPI number of 2.6. I want to shift gears a little bit to the budget and the details upon the defense buildup. There's a bit, speculate or hesitancy, if you will, again, to do that tax hike to meet some of their outlay plans for defense spending. Do we have more clarity on what the current administration wants to do on that front?
Well, I think there was a bit of a setback with the ruling coalition's loss of its majority back in last month's election. That makes it even harder for Prime Minister Ishiba to come through with plans to raise taxes. There was a report in the Sankei Shimbun this morning that said there's a plan within the ruling coalition now to postpone any talks of raising income taxes and focus more on tobacco taxes and corporate taxes. And that makes sense if you think about the context. The government's obviously very concerned about households, about wages, about real wages being in decline for many, many months. So I think at this point, what we can say is we don't really know the timing. It probably will be postponed again. But when they do start talking about details, they're probably going to avoid talking about income taxes for the time being.
Would anything sort of risk the build-up plan if they can't find the resources?
Well, I mean, there are a lot of risks. So Japan's debt to GDP ratio is poised to reach 250%, which is obviously the highest in the OECD. And, of course, we have a new administration coming in the U.S., and we expect Trump to put more pressure on allies to boost their defense spending as they take a larger portion of that burden. So Ishiba is definitely going to be looking at more pressure to come through with details. We did see with the extra budget, some of that money is going to be coming from bigger tax revenue than was planned. So that's a good thing. There's a little bit more money to use there. And there's also some unused money left over from this year's budget. So we spoke with the policy chief of the Komeito, and he said that while there may be some questions about how they're going to really come up with all the funds, they will find a way at this point, and the actual plan to boost defense spending and capabilities is not in jeopardy at this point.
All right, Bloomberg senior editor Brian Fowler in Tokyo, thanks so much. Well, now to some of the big corporate stories we are following this Friday morning here on the China Show. Tokyo Gas says it will look at a variety of options to help unlock the value of its real estate, including selling some assets. Japan's biggest utility gas provider will also look at ways to use its properties better. Activist investor Asset Management reported a 5% stake in Tokyo Gas last week and wants the firm to sell down holdings not related to its core energy business. And shares of South Korea's biggest music company, HYBE, fell in Seoul.
Not only real estate, but also other assets may not necessarily have high efficiency. So we will carefully review these areas and decide whether to sell them if necessary or to make good use of them through various financial methods. We will consider on a case-by-case basis what kind of approach is best.
And shares of South Korea's biggest music company, HYBE, fell in Seoul after K-pop superstars New Jeans announced they plan to part ways, alleging breach of contract. The move comes after a months-long revolt by the group against their label, which is an affiliate of HYBE. The performers told a news conference in Seoul that they may no longer be able to use the New Jeans name. The group generated about 5% of HYBE's sales last year. And Saudi-backed LIV Golf is said to be weighing a potential deal with Europe's DP World Tour. The talks may see the two competitions merge, creating a share schedule and allowing golfers to play in both. LIV Golf started as a rival to the PGA Tour, luring top players and sparking animosity with the existing tours. All right, plenty more ahead. This is Bloomberg.
23 minutes into the session so far for Chinese equities this morning. Taking a look at some of the movers in focus, we're actually seeing New World Development and Chow Tai Fook both moving a little bit higher here today. The story is that New World is selling its sports park to Chow Tai Fook for 417 million Hong Kong dollars. That's about 53 million US dollars. But essentially, this is all about that deleveraging that New World needs to do. Basically, Chow Tai Fook is one of its major shareholders, or a substantial shareholder in the company. That's there. Let's also take a look at what's happening with earnings this morning, because Bosidang is in focus. We're actually seeing those shares flat. They moved a little bit higher at the open. They've reversed those gains. We did actually see results beating estimates given the sales momentum. Meituan actually is the low one in the green today, and there's a lot of optimism around this company, what it's been able to do to expand its user base, fend off competitors in a very aggressive delivery market. They've got quite big expansion plans as well, and also taking a look at some others more in the shipbuilding space. But again, it's still that earnings focus today. Broadly, taking a look at how benchmarks are faring so far in the session today, and we are seeing the CSI 300 just a little bit high. The Hang Seng, though, very flat, Steve.
Meituan, according to Morgan Stanley, is defying gravity.
Is that right?
In a recent report, yeah. That'd be nice. All right, coming up in the next hour, we speak with WPIC Marketing and Technologies about China's fastest growing consumer segments and where they are seeing the growth opportunities. We'll have a lot more on the way in the next hour. Of course, you're watching the China show. Are we going to see a shot of, yes, the Orient Pearl Tower in Shanghai? Oh, it's a beautiful day in Shanghai, coming from our office there in Lujiazui. This is Bloomberg.
Welcome back to the China show. Taking a look at how the CSI 300 is faring half an hour into the session today. Actually, we've got a little bit of upside coming through, but we do see the MSCI China flat today, and trading volumes, I just took a look at those, and they're fairly thin. So it's kind of a, I guess after Thanksgiving holiday this week, and sort of a lot of uncertainty, it seems like traders are maybe just a little bit more sitting on the sidelines today.
Yeah, and China's still sort of waiting for the China Economic Work Conference next month. This is the last trading day, of course, of November, to see whether stimulus is going to come through as speculated. But we're also watching a number of other things across the region, including the Japanese yen, which has breached 150. It's strengthening. It's now 149.94. You had Tokyo CPI hotter than expected at 2.6%. But then again, there's also thin liquidity right now, and also traders are now starting to raise the odds of a December BOJ rate hike. Those odds now at more than 60%. So again, that's putting a little bit of fire under the Japanese yen, strengthening against the U.S. dollar to 149.98.
Yeah, I think you've probably found the most interesting topic in Asian markets to talk about this morning, what's happening with the Japanese yen. But across the rest of the trading complex this morning, again, as we said, it's fairly steady. We're not really seeing any movement in the broader benchmark. Japanese equities, of course, reacting to that stronger yen dynamic, and we're seeing those sliding 0.6%. The Kospi as well, actually quite a significant drop there, down 1.9%. Taiwan, another tech-heavy index, fractionally in the red there. Aussie bond yields, one to track as well, given we just had the RBA Governor, Michelle Bullock, pushing back on those rate cut hopes. And actually, we heard from ANZ earlier as well, and they've pushed also their rate cut bets to May. They had previously seen February, and they're now seeing 2 25 basis point cuts instead of 3. So it's a shallower easing cycle to come as well. But let's stick with that central bank focus and what we're going to be seeing from some of the major ones over the coming months. Let's bring in Garfield Reynolds, who leads our Markets Live Asia coverage and joins us now. And Garfield, off the back of that Tokyo inflation reading we had this morning, is that changing your thinking around what the BOJ does at its next meeting at all?
I think it more acts to reinforce it. The BOJ has been edging towards accepting that it's time to hike rates, and by now they risk plenty of market volatility if they don't. They also face a situation where their only alternative to hiking rates is probably to say, look, we're not hiking this month, but here's our plan for hiking, in 2025, which might even end up sounding more hawkish than if they hike and say, okay, now we can wait and see. So that's coming. That's helping to drive the yen. There are other things that are driving the yen stronger. A big part of it is the backdrop for a lot of currencies all around the globe is what's coming when Donald Trump returns to the White House. And even if various countries can placate him somewhat on the tariff front, you're still going to have this bias to follow the playbook in FX markets from last time round. Last time round, we saw the yuan declining, we saw the Korean won declining, we saw the Mexican peso hanging tough. The clearest gainer that we saw outside of the US dollar itself at some stages was the yen. The yen did just fine. So the yen's attracting some haven flows from that point of view. The skew for the yen is down, and probably even helping that is there's not a lot that really screams out that it should go at a rapid pace. There's also not too much concern about any fresh carry trade squeezes like the one we got back in July. So all of that sets up for a bout of sustained yen strength.
Well, Garfield, given what the BOK did yesterday, surprising the market, obviously with that 25 basis point cut, successive cuts coming from the BOK, and we all know that the BOJ governor is fairly cautious right now. Does that give him room essentially to also pause, or are the bets still adding up that they're going to hike?
The bets are actually getting stronger that the BOJ is going to hike, and in a lot of ways, what even helps on that front has been what's been going on with the Fed. That's the gorilla in the room anytime when you come to looking at rates, especially for developed market central banks. So the Fed, we're waiting to see what they're going to say. You would have to bet that they're going to give some guidance to push rates traders one way or the other, given what happened last time. We were at sort of 50 to 60% in favour, or even less than 50% in favour of a 50 basis point cut back in September, and the Fed came out and made it pretty clear, no, we think we are going to go 50. So by the time the actual meeting came around, the pricing was pretty close to what the Fed did. So we've been fluctuating between 40% and 60% for a December rate cut. I would expect in the coming week, and especially as the data comes in, the Fed is going to make it clear, okay, we're 90% likely to go, or we're 90% likely to stay where we are. Once then that December meeting is out of the way, one way or the other, you're going to get a clearer path for the Fed. You've got a Fed that is definitely not looking to rapidly cut rates, and that helps the Bank of Japan as well. If the Fed was looking like it was going to rapidly cut rates, then you would probably already have the yen back down to 145 per dollar or something. And that's the sort of thing that would give the BOJ serious pause.
I want to shift now to what else is being very closely watched this morning. And that's what's happening in Brazil with these government spending cuts that didn't seem to go quite far enough. We're seeing that second-order reaction to Brazilian-linked assets in Asia this morning. But Brazil, is that sort of telling us about could be a global concern around fiscal deficits?
Oh, it does help to emphasize that. And I think it helps to emphasize the ongoing problem about government credibility around the globe and government credibility in being able to navigate what is actually now a pretty difficult path in a lot of nations. Under COVID, central banks were backstopping you to throw around as much money as you liked, and you had the credibility to do that. It's like you're saving the world, as it were. But the bills have been coming due for quite some time, much like France finds itself in a very intractable situation. Brazil does as well. And you look where Lula and his finance minister had been saying they were going to be prudent, saying they were going to cut spending. They finally came out and said, hey, we're cutting spending, and we're cutting it by about $12 billion US. And the markets have gone, we're not sure that that's enough, and we're not sure that we believe, because we don't see enough details about it. So now they face the unenviable situation of somehow having to square that circle. They probably don't want to cut too much more because they're worried about what that's going to do for growth. Meantime, the loss of credibility has sent the currency crashing. That's raising pressure on the Brazilian central bank to hike rates, maybe to intervene, and to add to all of the uncertainty that Brazil is facing is the fact that they're going to get a new central bank governor in the new year. So the current one only has one meeting left, a short amount of time to try and help undo some of the damage that ultimately the government's mishandling of its fiscal outlook has provided. Now, that's the sort of situation that a lot of governments around the world have been struggling to avoid, precisely because we have this mismatch between what governments want to do, what they can afford. We've got these high interest rates, around the globe. Even in Brazil, after it had carried out rate cuts, interest rates there are still relatively high, and now they're looking at having to hike them, back up further. So that's a conundrum that's causing problems for Brazil-linked stocks as it is right now in Asia, as you mentioned. But it also underscores that this is a challenge that a lot of governments around the globe are facing.
And you're seeing the Brazilian real right there sinking as much as 1.5% on Thursday to that record low. Garfield Reynolds, he leads our MLive Asia coverage. Well, coming up, we'll be taking a look at China's consumer market with WPIC Marketing and Technologies. That's coming up next. You're watching The China Show, and this is Bloomberg.
Taking a look at how Hong Kong markets are faring this morning and mainland China, we're seeing a little bit of divergence coming through. We've got the Hang Seng just a little bit under pressure, the CSI 300 0.4% to the upside, and we actually are seeing weakness across Korea and Japan. Definitely that Japanese yen strength we've got this morning is playing into that. It sort of is a drag on the exporting names. The Kospi, one of the standouts to the downside because we're seeing it off 1.8%. Still wrapping up the earnings season in China today, and Meituan is going to be one of the last major ones to be reporting. It's a little bit under pressure so far, but it certainly has been doing really well, enough actually to be the heaviest weighting now on the Hang Seng index, and certainly one that's been managing to fend off very stiff competition.
Stocks up 110% so far year to date. Third quarter was up 55%. Adding to that, it was adding to it. No, it's down now, as you just said, by about 0.2% ahead of those earnings.
Let's actually take a bit of a deeper dive into what's happening into China's consumer sector. Our next guest says he's seeing strong growth in online sales in beauty, personal care, and other segments are being shaped by new lifestyle trends. So let's bring in Jacob Cooke. He's CEO of WPIC Marketing and Technologies. And Jacob, really interesting report sort of laying out the differences and we're seeing in consumer trends, but also in different channel preferences as well. So what stands out to you right now, given there's a lot of concerns around the fragility of the Chinese consumer? Is that what you see on the ground?
Not so much fragility. I think what we have sort of in Q4 and coming out of Singles Day is actually very strong. Normally, our predictions are pretty right within a couple of percent. This year, it kind of beat by about 5%, roughly, I think, 20% year-over-year growth. And that's in line with what we expect from Meituan too as well today. Yeah, it's a different consumer. It really is. And it's way less Louis Vuitton and it's way more Lululemon. People are taking better care of themselves. We see personal care, cosmetics, these types of sectors still way up in double digits. And if you look at outdoor activities, people they're doing new activities, Lululemon, Arc'teryx, these types of brands that are doing really well where there's pressure on the Louis Vuittons. And that's just reflective of the new generation. They're shopping different, they're behaving different, they're consuming food different. Really than what their parents did. So I think when we look at that consumer and we're understanding what categories are going to be hot, we're still seeing very strong online growth, even much better than what we saw in 2023.
Jacob, Steve Engel here. Did you see, in your research, a direct correlation to the meltdown in property and household wealth and their ability then to have that discretionary income to buy the big ticket items? It seems like they're getting a lot of consumption vouchers and also trade-in programs by the government for white goods, but they're not buying big ticket. Is that a direct correlation because their household wealth has really tanked because of the property meltdown?
In some sectors, like large durables for sure, and the coupons were necessary, and now we've seen appliance sales. The coupons, the rebates are definitely a big part of that, but there's also been a lot of innovation in that space. So a lot of the smaller new appliances, like sous vide and these other trends that are popping up right now. But, we actually were studying the inverse of this, in Xiamen when property prices were taking off and how it related to Apple sales. When property prices were actually taking off and household wealth was going up, we actually saw big reductions in purchases at the same time. People were paying more for mortgages. Nowadays, with not so much money going into real estate, I think what's actually happening is consumers are not saving up for that second, third, and fourth apartment, thinking that is the quickest path to getting rich, but spending a little bit more time traveling. We see, great Golden Week holiday here too this year, and taking care of themselves a little bit better. And that's what people are spending their money on. So no, we don't see that for sectors that are not related to the house. So like furniture and large durables, yes. I mean, there's going to be downward pressure there with simply less homes being purchased. But in terms of other consumption, outdoor activities, big time travel, restaurants getting back now. No, we see it actually better than expected now in Q4. So no, we're not really expecting that to go on into 2025 either.
Well, we've had 9 consecutive months of low single-digit growth in retail sales. October was the best this year at 4.8% on the back of that stimulus that we got at the end of September. But that enthusiasm sort of has petered out, at least on the markets, and everybody's waiting for this China Central Economic Work Conference next month, or coming up potentially as early as the beginning of December for stimulus. What kind of stimulus do you think directly is needed on the fiscal front?
Well, I think one thing that's happened now is we can probably talk about consumer stimulus here too, but at least what's happened this year too is, a lot of the layoffs post-COVID have stabilized, and companies that were laying off, especially in tech last year, have gone back to hiring. That's great for consumption too, and people feel very secure in their employment. There's always been that up or down here about whether there's actually going to be cash in jeans injections for consumer stimulus. And whether it happens or it doesn't, we're not really sure about that because the consensus shifts on that so much. But if people are secure in their jobs, and there's some type of rebates we'll have to see, then yeah, we could have a very good year for consumption next year. But even as you're saying, talking about retail sales, remember that's all in aggregate. You have Lululemon reporting 40% up, who's primarily a retail brand in China too. So yeah, you might have LVMH down and Lululemon way up, but there's definitely some big winners here still in retail sales that are conforming to that new consumer.
One of the things that I really found interesting in your report, Jacob, was the growth that we're seeing in Douyin, which for people unfamiliar, it's TikTok in mainland China. It's an interesting concept that you actually have a platform that can sort of start to create and lead those trends itself. And maybe we're seeing sort of something similar with Zhao Hongshu. So who do you think is navigating these changing consumer trends the best? Which platform?
Well, it actually started with Alibaba. When you talk about live form and short form video and using that to sell, TikTok has really mastered that now with Douyin in China. And we actually see that not only in China, but catching on around the world. So we're really paying attention to that as well. And I think if we look at the investments that Redbook or Zhao Hongshu has put in this year, we're actually predicting that's going to be a big story of 2025 in terms of their GMV growth right now. They're way behind the big guys, but if you look at the advertising spends and some of the reports that have come out already, brands have really started to focus investment because Little Red Book or Zhao Hongshu is a huge influencer in terms of people's purchasing behavior. What they're trying to do now, which is really a second try at this, is to get that actual conversion to happen on the platform too. They've poached a lot of people from Douyin, they've poached a lot of people from Alibaba, and they're really putting in a bigger investment to try to get that done this year. And we expect that to be pretty successful.
You've mentioned the success that we're seeing for Lululemon, for instance, over Louis Vuitton, but I'm curious how the conversations that you're having with Western brands, because over the 11/11 sales period, one report that stood out to me, even though Alibaba rejected it, but was Ralph Lauren essentially had been sort of caught up in this, that people were sort of gaming the platform to buy in large quantities Ralph Lauren product to then return it immediately. Are Western brands facing any challenges in navigating these consumer trends as well in this really rapidly evolving market?
Yeah, I'd like to clarify that too, because that's not new to this year. That's actually been going on for a couple of cycles now too on 11/11. What they're doing is they're just trying to get that shopping cart up to a threshold where they can qualify for a coupon, usually around $50 to $100, and then they'll cancel part of the order. there's actually been penalties now put in place for consumers. So we actually would have expected that particular metric to be down this year compared to last year. But that's certainly part of it. But no, not overall, and I don't think significant in terms of what we're seeing from consumption growth.
All right, Jacob Cooke, CEO of WPIC Marketing and Technologies. Looks like it's a blue sky day there in Beijing. Get out and do some shopping yourself. We'll leave you with a look at Chinese food and dining stocks now in the green. Wow, pretty good right now after a Ministry of Commerce briefing on efforts to boost consumption. And we're all on stimulus watch. Haven't we been on that watch for the last 6 months or so, Annabelle? But look, consumption stocks doing pretty well right now as we head into the last trading day of November. Plenty more ahead. This is Bloomberg.
It doesn't actually make social media safer for young people. And that's the devastating thing about this. Because we know that there are families who are struggling with this. We know there are young people who are struggling with their body image, their connection with their community, their peers. Young people who are finding themselves addicted to these dangerous algorithms. But this bill doesn't do any of that.
That was the Australian Greens Senator Sarah Hanson-Young speaking in opposition to a social media ban for under 16-year-olds that was voted into law late last night in Canberra. Bloomberg's Paul Allen joins us now for more. And Paul, we were just talking there in the ad break. This is certainly a program or a policy that's got a lot of public support or broad public support in Australia, but there's certainly plenty of critics as well. So how did it get through Parliament then?
Yeah, it's been really interesting watching the battle lines get drawn on this. I mean, there you have a Greens senator who's basically taking the same side as Elon Musk in this debate, although albeit for rather different reasons. But the whole crossbench in the Senate opposed this, including 2 members of the opposition coalition. But the rest of the opposition and the government supported this. So there's bipartisan support. The Prime Minister supports it. The opposition leader, Peter Dutton, supports it. And the public overwhelmingly supports it. In a recent YouGov survey, found 77% among voters supporting this action. So parents want action here. There are so many examples of social media bullying. There have been plenty of cases in the media here about youth suicide connected to social media. And suicide is now the leading cause of death among 10 to 17-year-olds in Queensland, and there's typically been some sort of social media or online undertone to that. So that's the intention of this law, to address that. But the question is it going to work? Part of the problem here is the onus for making it work is not on parents, it's on social media companies, and if they don't make it work, there's a fine of up to $32 million for failing to do so.
Well, Paul, what's been those social media platforms' reaction?
Overwhelmingly not good, as you can imagine, and Elon Musk has really been leading the choir here. He says it's a backdoor way to control internet access for all Australians. X itself calls it, says there's serious concerns over the lawfulness of this. TikTok called it rushed, unworkable. That's some of the criticism we've heard in Parliament as well. Meta says it overlooks practical realities of age assurance technology and it doesn't make youth safe. And that's before we even get into all the exceptions on this. WhatsApp is accepted from this law. So are all messaging platforms. Online gaming is exempted from this law as well. So obviously these are still spaces where bullying, grooming, all these terrible things can take place. So the criticisms are certainly valid. There's still a lot of debate around this. The law's not going to come into effect for another 12 months. So potentially some time to iron out some of these concerns and figure out a way to make it workable.
That was Bloomberg's Paul Allen there in Sydney, and you'll have to canvass some of those opinions of the under-16s as well. But taking a quick look at movers, a different landscape or different part of the market today, digital services companies in focus in China. We're seeing those rising. Actually, the government is vowing to ease market access for the sector. And they're also planning to encourage foreign investors to expand their investments. So those ones moving to the upside. It's 11:29 a.m. in Tokyo. Japanese markets are just about to go on their break, and maybe for equities traders, they're just happy to have a bit of a relief for 1 hour as they sort of digest those Tokyo inflation readings this morning, because it came in hot, definitely about that 2% inflation target from the BOJ. It puts that BOJ decision very much a live one for next month, and watching the Japanese yen, even though, of course, FX traders, they don't get that break instead.
Yeah, as an American, Friday after Thanksgiving is all about digesting. Okay. Absolutely. So thin liquidity out there, but a lot of indigestion going on in the markets, as you can see there.
Yeah, and taking a look at what's happening more broadly as well, because we are keeping a track on Asian equities. Actually, they're fairly flat to end the week. And as you said, Steve, it sort of is that flow on from Thanksgiving. We didn't get, of course, any trading overnight, and so that sort of sets us up for a fairly lackluster end. I'm just taking a look at trading volumes right now, and around the region, they're well off their 20-day moving averages. But what is coming a little bit under pressure is the tech space so far, and that's as we approach as well those key Meituan earnings.
Yeah, that's right. And we also get China's next big data point on Saturday with the November PMI numbers. Let's cross over here and get a preview from our China correspondent, Min Lo. What are we going to see in this confidence recovery? How much sustainability is it?
Yeah, if we're hoping to see the stimulus really showing up in the macro data, we're likely to be disappointed, because according to the consensus forecast, the PMI, the manufacturing PMI, expected to come in at 50.2, slight pick up from the previous month of 50.1. But this is likely because of seasonal fluctuation, because remember in October we had a shorter working month because of the Golden Week holiday. So there is naturally a slight uptick in November, not likely to signal that the economy is actually gearing up. When it comes to the non-manufacturing PMI, that's expected to come in at 50.4, up from 50.2. The services PMI expected to remain quite steady, but when it comes to construction, though, Bloomberg Economics is saying that we are likely to see a slowdown there because you have winter approaching. We had 4 typhoons in southeast China, and then we also have the increase and uptick in steel rebar inventory, suggesting that there's continued weakness in property investment.
So where does that leave the PBOC then in terms of the room for easing? Because we're seeing local news reporting, for instance, from an ex-PBOC official saying that they do have that space.
Yeah, I mean, this is sort of well telegraphed by now, because the current PBOC chair, Pan Gongsheng, had said in September that he sees room for more RRR cut by the end of this year if necessary. And this ex-PBOC official is saying we could see maybe 25 to 50 basis points cut later this year. He's also seeing potential 40 basis points cut in future as well. And this is going to be very closely watched, especially the timing of it, because we know there is the threat of tariff that is putting a lot of pressure on the yuan, but the PBOC has really been defending the value of the yuan, setting the yuan, the fix at no weaker than 7.2 yuan per dollar so far over the past 2-3 weeks. So that does give them a bit of breathing room to cut RRR without causing sort of a knee-jerk reaction of capital outflows there. But the question is, how long can they sustain this competing priority that the PBOC has to balance out?
Yeah, certainly some sustained and very structural problems facing the economy. That was Bloomberg's China correspondent Min Lo there. And one of those, of course, is the property sector, and that's having flow-on effects to what we see in Hong Kong as well. Because earlier, Steve and I were speaking with the Hong Kong-based real estate investor Link REIT, which has released its 2025 interim report, saying that market conditions are just going to remain challenging, and there's really sort of kind of seemed like there was no end in sight on that one. We spoke exclusively to George Hongchoy. He's executive director and group CEO of Link REIT's parent, Link Asset Management.
One of the things that have dampened Hong Kong's retail sales, a lot of our Hong Kong shoppers have gone across the border to shop, and almost an imbalance of not having that many to come back towards our way. And so we are looking forward to welcoming more people to come more often. This is something that we had many years ago and was suspended, and so we're very pleased with the announcement. The mix of the visitors has also changed over the years. More second, third-tier cities to bring back frequent visitor from Shenzhen and Greater Bay, certainly, including Hong Kong as a regular visit location within their 1 hour or 2 hour living zone is very important for Hong Kong.
How would you sort of think about the consumer? Is there a difference between a Hong Kong shopper versus one coming from Shenzhen? I mean, we've often sort of thought about maybe that you can have a lower spending per person, but actually I attended an event at Shao Hongshu the other day, and they were saying that people are spending quite a lot. So what's your sort of projections?
The mix of shoppers have really changed over the years. A lot have come to Hong Kong still for some of the best shopping and restaurants. Hong Kong shoppers have gone up to China, to Shenzhen for services, for food, etc. And I think having that option for them is important, to be able to come as often as they like. Obviously, what we need to do as a landlord and our tenants is making sure that we give our shoppers the right offering, local and visitors.
Well, how do you see these dynamics, obviously, with people going across the border to Shenzhen and shop at Costco or wherever, but also now, if more mainlanders are coming down here? Keep in mind, Hong Kong's expensive because of the dollar has been so strong for so long. So how is this overall into 2025 going to impact your retail leasing performance?
Hong Kong is facing a structural change, given that obviously shoppers are going to shop in China, to spend in China. But this is part of the development of us becoming part of Greater Bay, that Hong Kong people can have that choice of living, shopping within the entire region and vice versa. And so it is a change that we all need to adapt to. At the end of the day, for retailers, for restaurant operator, is how to have a great experience for anyone who come, and so have to constantly renew their offering. It is a good challenge. It's a competition, I guess, will hopefully bring the best out of Hong Kong, as we always do. And Hong Kong always will bounce back, and this is a great catalyst for us to be waiting for and now finally announced.
But you're saying that it's a structural change, and it seems like, I mean, if we're talking not just beyond Shenzhen, exactly, the Greater Bay Area has a lot of different options for consumers. So thinking about Hong Kong bouncing back, what's your timeline around that? And how does that actually play out?
Well, it will take a little while, partly because we also, part of the structural change is also the increase in supply of retail space in Hong Kong. And there's continuous supply over the next few years of new offering. Yeah. But that also could be bringing some excitement. Some of the design of the new mall is very attractive. There's a lot more things to do in terms of placemaking and activities rather than just coming out with a shopping bag. A lot of the experience that people didn't have when they come to Hong Kong. The mega events that the government has been promoting, including concerts and exhibitions and conferences, will continue to draw people to Hong Kong. And I think that, it will take time to absorb this supply and demand imbalance for a little while.
And that's George Hongchoy, Executive Director and Group CEO of Link Asset Management, speaking exclusively to us earlier this morning here on The China Show. And if you're a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function, TV Go. You can also join the conversation by sending instant messages to our team and our guests during our live shows. Check it all out at TV Go. This is Bloomberg. And welcome back. You're watching The China Show. Well, sources say Japan's biggest banks plan to maintain ties with billionaire Adani despite U.S. bribery charges. For more, Avril is with us from Singapore. So, Avril, what are we seeing among the Japanese lenders as it relates to Adani?
Yeah, it's really interesting, right? I mean, this is something that we've been discussing for the past week, whether the so-called reputational risk is going to affect, curtail perhaps, access to funding for Adani and its growth ambitions. And certainly it looks like for the Japanese lenders, according to sources, that they're kind of sticking to their guns in terms of support for the Adani group of companies. We have sources telling Bloomberg that Mizuho, doesn't see any long-lasting impact. We have Sumitomo Mitsui as well as Mitsubishi UFJ Financial Group. They're not at this point assessing and thinking of a pullback. And I think one analyst actually put it best in that a lot of these Japanese lenders have learned lessons from the 90s in assessing EM risk. And if you think about how ultimately India is still a really important growth market for them, you might see some assessing in terms of the processes tightening or maybe raising the risk premium, but ultimately the Japanese names are not going to substantially pull back on financing, especially given how at home they still have relatively low cost access to capital. So for them, it's really about seeking these growth opportunities overseas.
Barclays, though, the British lender, could be taking perhaps a little bit of a different approach.
Yeah, absolutely. I mean, I think some of these Western financial institutions are a bit reassessing their ties with Adani. Barclays is interesting because it has had long-standing relations with Adani. It's been a big backer for a long time, but we've seen how it's reduced exposure since the bombshell Hindenburg report from last year. And at this point, I think they're, kind of reassessing some of their ties, even though last year it did come through with a $400 million trade financing facility. And then you look at Jefferies, it has kind of stuck with the support with Adani even after the Hindenburg report. But at this time, it says it's not quite looking at some of these new projects or financing for it. It hasn't reached an outcome on that. It's going to wait for the outcome of the US case before sort of reaching a decision. And I think this is all part of how companies are reassessing their ties. I mean, you look at how this week we've seen Total, the French company, saying that it's not looking at these new, fresh investments into Adani. We've had the credit ratings agencies as well. They've lowered their credit outlook on some of these Adani companies. So a lot of reassessment going on here, guys.
Thanks. That was April Hong there in Singapore, and we'll have plenty more ahead. This is Bloomberg.
And welcome back to the China Show. We go to the Philippines now, and Philippine politics and a feud between two of the most powerful local clans. Vice President Sara Duterte is under investigation over alleged threats against President Ferdinand Marcos Jr. Her father, the former president, Rodrigo Duterte, has also called on the military to intervene to fix what he calls fractured governance in the country. Well, Bloomberg opinion managing editor Ruth Pollard thinks Manila cannot afford to be distracted by the latest round of clan rivalry. She joins us now. So, Ruth, thanks for joining us. What a saga it is unfolding. So far, the markets have not necessarily been too shaken, but it's definitely captured the tabloids. As far as political feuds go, this one is pretty spectacular. What has stood out to you, obviously?
For me, it's just how much the Dutertes have been determined to insert themselves into the political discourse around Filipino politics. I mean, for Sara Duterte to say that she had thought of beheading the president, that she wanted to dig up his father's body and throw him into the sea. And that, of course, as you noted, Rodrigo Duterte, the former president, saying the military should sort this out. I mean, all of this is incredibly inflammatory language. We knew that this political marriage of convenience between the Dutertes and the Marcoses wouldn't last, but I don't think anyone expected it to blow up in such extraordinary fashion.
So what's at risk then for the Philippines with that level of domestic infighting? Because, as Steve was saying, that the market reaction is kind of muted right now, but certainly the country does have a pretty long list of problems to focus on.
That's right. And I think under President Marcos, the Philippines has found itself in a pretty good place, both domestically and foreign policy-wise. President Marcos has moved the country to be on a much more stable footing with the US, which is a key treaty ally, and that has allowed him to then push back more firmly against China and its incursions into the South China Sea. So all of this, this focus and this discipline that Marcos has had in dealing with these external threats could be sidelined somewhat by all this domestic political drama.
So where does this saga go next? I'm seeing a headline crossing this saying that a police investigation has been moved tentatively to December 11th. I guess that's the next date to circle. But how does this play out, do you expect?
Well, Sarah Duterte is under investigation from several government agencies. Her father, of course, is under investigation from a parliamentary inquiry over his so-called drug war, which resulted in the death of thousands. And of course, the International Criminal Court is also investigating Rodrigo Duterte. And then that takes us to the midterms in 2025, where it looks like the whole Duterte family is going to nominate for various political positions. And so it will certainly, bring more political earthquakes, I think, for the Philippines in the months to come.
All right, Bloomberg opinion managing editor Ruth Pollard, thanks for keeping us up to date on what's happening in the Philippines. Now to some of the corporate stories we are following this Friday morning. Saudi-backed Live Golf is said to be weighing a potential deal with Europe's DP World Tour. The talks may see the two competitions merge, creating a shared schedule and allowing golfers to play in both. Live Golf started as a rival to the PGA Tour, luring top players and sparking animosity with the existing tours. Elsewhere, Renault is going on a hiring spree in China, a market where it doesn't even sell cars. Sources say the French automaker has hired 200 people in Shanghai, mostly hardware engineers working on development of its Twingo EV. We're told it plans to hire software engineers as well. A Renault spokesman says the firm is there to learn. China is one of the few markets where EVs are selling so well.
Well, let's take a look at what's actually happening in Chinese equities, because we're capping off November. This is the last day of trading, and this chart doesn't really tell a very good story, Steve, because you're looking at two of the major Chinese ETFs, and you can see there that bar in red or circle in red, and it's definitely saying that we are getting major outflows here. So this is actually record monthly outflows. You can see the inflows that came in after the stimulus announcement, all of that optimism. Of course, outflows tell you that there's a lack of confidence in what's happening with the stimulus measures. And you know what else adds to it is the concerns around US tariffs and how that has an impact as well.
Absolutely. It's adding to the volatility, and it's raising the risk profile for those who have assets in China, and finding potentially ways to exit, or at least soft exit for a while we go through this period of volatility, at least until or even well through the inauguration on January 20th of Donald Trump. And what do the tariffs actually end up being? Yeah.
And we've also got the EV makers that are the focus for this month.
We're always following the EV makers, as we just saw in that last story that I read. They are among the biggest losers this month as talks with the EU over tariffs drag on. The price war also that's cutting into margins shows no sign of easing.
Yeah, actually, on that note, one of the most read stories this week was that leaked BYD letter saying that, they're asking basically some of their suppliers possibly to put through even cheaper prices.
10% more.
Yeah,
cuts.
And so it's just that signal, that EV price war, it's not going away anytime soon. So we're going to keep tracking it here on Bloomberg TV. But the rise of China's EV industry has certainly come at the expense of global competitors as well. And we were talking again earlier this week, about what was happening with the Japanese names, the likes of Toyota, Nissan, Honda, that have all lost some market share in the country. But if you were to take a look at who's the biggest loser in
used to be the biggest.
It used to be the biggest, and over the past 5 years, they've actually lost, I think, 6% of their market share in the country. And if you haven't guessed who we're talking about yet, it's Volkswagen, of course, the German giant that's certainly been in a bad spot. So Bloomberg Originals, they've been looking at the existential challenges the company is facing and the flow-on effects for Europe's biggest economy. Here's a preview.
Cars are integral to Germany's modern economic and industrial identity, a pop cultural export and political lightning rod. 87-year-old Volkswagen embodies this on a global scale.
It employs 680,000 people around the world. It has dozens of production locations. Millions of people, workers in other industries, are reliant on the business that they get from this company.
It owns several household names. Some of those households are very wealthy indeed, while others descend from VW's principal demographic.
There was a big celebration in Germany to mark the 1 millionth people's car since the war.
The whole idea of the people's car was that every individual in the country would be able to afford one.
Decades later, in 2023, VW's portfolio generated 320 billion euros in sales, equivalent to about 7.5% of Germany's entire GDP from that year.
And subscribers can watch the full documentary on the terminal or at Bloomberg.com right now, and it'll be up later on the Bloomberg Originals YouTube channel. And if that's not enough, sorry, it's a late Friday. If it's not enough automobile news for you, today's big take is about Norway's preparations to complete a transition away from combustion engines, of course, the ICE engines, cars. Check out what the world's first all-EV car market looks like on the terminal or on Bloomberg.com.
All right, taking a look at what's happening in the markets, and I think, you know what, I feel like we're covering a lot of ground today, but what this one is about...
I'm running out of gas.
That's all right. We've only got a couple of minutes left. So we're going to talk about what's happening in the crypto space because, of course, there's been that sort of Trump-led rally. We know that he's got his own DeFi project, and actually Justin Sun of Tron fame has been investing quite heavily into that. But US Bitcoin ETFs are heading for record monthly inflows on all of this optimism. So you're continuing to see those gains. For instance, OSL, it's one of the very few licensed or fully licensed crypto exchanges here in the city, and watching some of those other linked names. Bitcoin, I mean, we came into the week thinking we might hit 100,000 per token.
Yeah. That's the elusive 100,000, right?
Yeah, we're going to be watching it. Of course, it could sort of prompt some selling activity off the bat because you could have people a bit of profit taking, maybe if you do hit that mark. What else we're tracking, and this, again, we're moving completely different direction, but what's happening over in Seoul today, because we've got HYBE that's a focus for us. Do you track K-pop at all, Steve? I'm curious.
What do you think? I'm a 58-year-old white male. No, my daughter does, obviously. No,
okay,
I
you've
don't.
got a little bit of exposure to it then, but there's a story that the K-pop group New Jeans is actually splitting or terminating their contract with HYBE's affiliate label ADOR, and they're essentially citing the sidelining of their manager Min Hee Jin. So that move could actually end up triggering a bit of a legal battle between the artists and HYBE, and that could affect the group's ability to use their current name. So that stock there a little bit under pressure. That's it for the China show. We're going to have more with Haslinda Amin. Chinese equities a little bit under pressure. Meituan, the big one to watch today as well.
It's pumpkin pie time.
Absolutely is.